We talk a lot about financial freedom, but so often it feels like this big, abstract goal.
It's a dream, something you think about, but it's totally intangible.
Like winning the lottery or something. It doesn't feel real.
And that abstraction is, well, it's the biggest roadblock. All the foundational research we looked at for this deep dive points to one thing.
Which is?
It's a quote that really stuck with me. The clarity of your objective determines the precision of your trajectory.
They can't just aim for rich.
Exactly. Or comfortable. You need a number, a precise number.
So that's our mission today. We're going to translate that abstract dream into a concrete, quantifiable target.
We're using some really solid financial studies and strategies to figure out the exact investment capital you need to cover your annual expenses, all from passive income.
And it really goes down to two questions for you, the listener. First, how do you turn your yearly spending into one big investment goal?
And second, what are the crucial assumptions that have to hold true for that number to be reliable, not just for a year, but for decades?
Okay, let's get into the math. Because if you've ever felt lost trying to figure out your freedom number, the research points to a surprisingly simple formula.
It's almost deceptively simple.
You just take your total annual expenses, everything,
Every single bill.
and you multiply that number by 25.
That's it. That multiplier, 25, is the key. And it's not random. It doesn't come from thin air.
It's tied to the 4% rule, right?
It's the direct reciprocal of the 4% withdrawal rule. Probably the most famous, most debated retirement strategy out there.
So if you're multiplying your expenses by 25, you're basically working backward. You're saying that 4% of that final number needs to cover your entire year.
Exactly. The whole hypothesis is if you can build up that pot of capital,
Your objective.
your objective, right? And then you only withdraw 4% of it each year, that withdrawal should cover everything. And this is the critical part the data stresses, the original capital, the principal, should stay intact.
Or at least not shrink too much over, say, 30 years.
Right. Its erosion should be strongly limited.
Which means the money you leave invested has to be growing faster than what you're taking out.
Faster than your 4% withdrawal plus inflation.
So if you're taking out 4%, your portfolio needs to be making, what, 7% on average?
Yeah.
Just to keep its purchasing power.
That's the core assumption. We're operating on the idea that a well-diversified portfolio, stocks, ETFs, will get an average real return of more than 4% over the long haul.
Let's make this real. We've got a case study from the materials for someone named Sandra. She's aiming for what they call intermediate freedom.
So covering all her current expenses.
Right. Her monthly costs are about $1,400. That's $16,800 a year.
And she also added another $2,400 for those bigger annual things. Insurance, holidays,
Unexpected stuff.
always.
So her total annual expenses come to $19,200.
Okay.
We take that number, $19,200, and multiply it by 25. And her intermediate investment goal is €480,000.
480,000 euros. That's the target. It's a big number. It's a mountain to climb. But now it's visible. She can actually see the path.
That formula is so clean and simple, but the second you see a number like €480,000, you have to ask,
Is this real?
yeah, is this just wishful thinking, or does it actually hold up against, historical data? We have to look at the academic proof.
We do. And we're really leaning on two major pieces of research here. One that justifies the 7% average return we need for growth.
And the other?
And the other justifies the sustainability of that 4% withdrawal rate itself.
Okay, let's start with the growth side. This idea that you can reliably average a 7% real return, so after inflation.
Right.
Where does that come from?
The foundational source here is Jeremy Siegel's famous book, Stocks for the Long Run.
Oh, I know that one.
It's a classic. And Siegel didn't just look at the last 20 or 30 years. He analyzed over 220 years of U.S. stock market data.
220 years. How do you even do that?
He had to meticulously reconstruct portfolios going way back. Then he used S&P 500 data after 1926. And the key is, he included dividends and adjusted everything for inflation.
So he's measuring the actual growth in your spending power through wars, depressions, tech booms, all of it.
All of it. And his conclusion was pretty stunning. U.S. stocks gave an average real return of 6.9% per year.
But basically 7%.
Which is why the data calls that 7% figure a realistic and conservative base for these kinds of long-term models.
Okay, so the long-term history validates the growth part of the equation. But wait, if that's all based on U.S. stocks, Isn't that a huge risk, relying on just one country's market?
That is a fantastic question. It gets right to the heart of diversification.
I mean, everyone says to diversify globally.
They do, and for good reason. It reduces volatility and that kind of geopolitical risk. But the data also warns that diversifying globally can potentially pull that average return down a little bit, maybe below 7%.
So this is a trade-off.
It's the classic trade-off. You might swap a bit of a higher return for more stability. But as a baseline to set your goal, 7% is a very solid starting point.
Okay. Growth side, checked. Now, the withdrawal side, the Trinity study. This is the one that really tests if taking out 4% means you won't run out of money.
Right. The Trinity study ran thousands of simulations. They took different retirement periods, up to 30 years, and tested different withdrawal rates against every historical market condition you can imagine.
Great Depression, the 70s inflation.
All of it. And they used different mixes of stocks and bonds.
And what did they find for that magic 4% number?
The result was highly sustainable. Over a 30-year period, which is a pretty standard retirement horizon, a 4% inflation-adjusted withdrawal had a success rate over 95%.
As long as your portfolio had enough stocks in it.
As long as it held at least 50% in equities, yes. That success rate is powerful validation. It shows 4% isn't some reckless gamble.
It seems pretty solid.
It is, but we do need to pause here for a second. This is important.
The disclaimer.
The disclaimer, yes. These are all simulations based on past performance. And nobody can guarantee future returns. That 7% average includes years the market crashed 30%.
Right. It's an average. Your actual results will depend completely on when you invest and what the market does after.
It's that sequence of returns risk. If you retire right into a huge crash, even a 4% withdrawal can hurt you badly at the start.
So these studies were like a map, not a crystal ball.
A very good map. But the terrain is always changing.
Okay, so moving on from that single massive number, one of the smartest things the research does is break this whole goal down. It creates 3 distinct levels of freedom.
Because staring at a number like €500,000 can just be paralyzing.
It's discouraging before you even start.
Right. By breaking it down, you turn this giant finish line into a series of, achievable checkpoints. It's a huge psychological boost.
So let's define that first checkpoint, level 1, basic freedom.
This is your survival number, the investment you need to cover only your absolute essentials.
Rent or mortgage, food, utilities.
Exactly. Basic transportation, your phone bill. Just the things you cannot live without. For Sandra, she calculated this at €900 a month. That's €10,800 a year.
Okay, so 10,800 times 25.
Yeah.
That gives her a basic freedom goal of €270,000.
And that number suddenly feels much more attainable than $480K, doesn't it?
Much more. And it's so powerful because if you hit that number, you're free. If you lose your job, you can survive. The stress is gone.
It's the ultimate security blanket. Then you move up to level 2, intermediate freedom.
Which is the one we calculated before.
Yeah.
This is covering your entire current life.
The luxuries, the hobbies, the holidays, everything you spend money on now. For Sandra, that was the full €19,200 a year.
Giving her that 480,000 objective. This is the goal most people probably think of, right?
Yeah.
Maintaining your lifestyle, just without a job.
It is. And then finally, there's the aspirational goal, level 3, ideal freedom. This is the capital needed to replace your entire gross salary.
Wait, why is that important? If level 2 already covers all your expenses, why would you need to replace your whole salary?
It's about the buffer. At level 2, you have no margin for error. You haven't really accounted for big one-off costs or, critically, taxes.
Taxes, right.
Sandra's salary was €2,000 a month, so $24,000 a year.
Multiply that by 25 and you get 600,000.
And that's her aspirational number. Hitting that doesn't just cover your life now. It gives you a huge buffer for surprises, taxes, maybe some lifestyle inflation.
So you have these 3 clear targets, 270K, 480K, and 600K. It's a real roadmap.
Knowing the size of the mountain is one thing, but how you come down it, how you manage the withdrawals, that matters just as much.
And the research points out a really critical detail about how the 4% rule actually works. It's not as simple as it sounds.
No, it's a detail that gets lost all the time. The classical original 4% rule is not taking 4% of your portfolio's value every year.
So how does the classic version work?
It's 4% of your initial capital, the amount you have on the day you retire. That amount is fixed, and then you just adjust it for inflation each year after that.
Okay, so if you start with 500,000, your first year you take out 20,000 share.
Right. And if inflation is, say, 2%, the next year you take out 20,400.
Even if the market crashed.
You take that amount whether your portfolio is up 20% or down 20%.
The trade-off there seems huge. You get a very stable income, which is great for peace of mind.
But if a crisis hits right at the start, you're forced to sell your investments when they're at their lowest price.
And that could wreck your capital really fast.
Which is why there's another approach, the prudent variant, a dynamic approach.
And how does that work?
With this method, you withdraw 4% of the current portfolio value each year.
So your income is now tied directly to the market. If there's a 2008-style crash, your income for the next year just shrinks.
It does. You're forced to tighten your belt.
But the flip side is your capital is much safer. You're never selling off huge chunks during a downturn.
Exactly. The classical rule prioritizes a stable lifestyle, but it risks the capital. The dynamic version prioritizes the capital, but at the cost of a stable lifestyle. You have to decide which risk you're more comfortable with.
You know, for anyone listening looking at these numbers, whether it's 270,000 or 600,000, it can still feel incredibly far away.
You can be so discouraging.
But this is where we have to talk about compound interest, about exponential growth.
Yes, your financial progress is not a straight line. It is not linear. It's exponential. The time it takes you to get from 0 to your first 100,000 is so much longer than the time it takes to get from, say, 500,000 to 600,000.
That is the mental shift that is just so important to make.
It's everything. The research is clear. The first 100,000 is the hardest, period.
Because at that stage, almost all the growth is coming from you.
It's your sweat, your savings, your salary. The portfolio itself isn't big enough yet to do the heavy lifting. That period tests your discipline and your patience more than anything else.
But once you cross that line,
you unleash the snowball effect. The capital starts generating more capital than you're even putting in. The gains start making their own gains.
And the time it takes to add the next 100,000 gets shorter.
And shorter and shorter. That first phase is like a rite of passage. If you can master the discipline to get through that, the acceleration just takes over.
This has been, wow, a really clarifying deep dive. Let's try to boil it down. What are the key lessons we've pulled out today?
I think there are 4 big ones. First, the 25x multiplier. It's the tool that turns your expenses into a real, tangible objective.
Second, the 4% passive income goal. It's not just a guess. It's backed by some serious historical data, like from Siegel and the Trinity study.
Third, breaking it all down. Those 3 levels of freedom, basic, intermediate, and ideal, they turn this one giant mountain into 3 smaller tactical hills you can actually climb.
And finally, that psychological shift. Understanding that progress is exponential, not linear. The beginning is a grind, but that grind is what builds the foundation for compounding to take over later.
That's it. That's the blueprint.
So before we wrap up, we should just say again that while we're using all this great data, this is all for educational purposes. It's not personalized advice.
Absolutely. You have to do your own research. Think about your own timeline, your own goals, your own tolerance for risk.
And to leave you with one final thought, it comes from Charlie Munger. He had this great line.
Take ideas from wherever you find them, but use your own brain to assemble them.
So think about that calculated freedom goal you have now. What's one small change you could make today? Not just in how much you save, but maybe in how efficiently your money is working for you. That could help you move exponentially faster toward that number.